The stock market is a fascinating place. It's not a casino, though some people treat it like one. Think of it as a giant marketplace. Instead of selling fruits or vegetables, this market sells tiny pieces of companies. These pieces are called stocks or shares. When you buy a stock, you become a part owner of that business. You own a small slice of its future. If the company does well, makes great products, and earns a lot of money, the value of your slice can go up. This is how people begin their journey toward building wealth over time. It is a powerful tool available to everyone. Many people hear about the stock market and think it's only for Wall Street experts in fancy suits. This is simply not true. The market is open to anyone with a little money to invest and the willingness to do some homework. The main purpose of the stock market is to help companies raise money to grow. They sell these shares to get cash for new factories, more research, or to hire more people. In return, you, the investor, get to share in their success. It is a wonderful system that has helped build great companies and has rewarded patient investors for many decades. The real secret is understanding what you own. If you buy a stock in a coffee company, you should know a little about it. Do you like their coffee? Are their stores always busy? Do they have a plan to open more stores? These are the simple questions that can lead you to a great investment. You have an edge because you encounter these companies every day in your own life. You see what's popular at the mall, or what new software everyone at work is using. This everyday knowledge is a powerful advantage that professional analysts sometimes miss completely. So, the first step is to change how you see the world around you. Every brand, every store, and every popular product is a potential investment opportunity waiting to be discovered. The stock market is not some mysterious code to be cracked. It's a reflection of the real-world economy. By paying attention to the businesses you interact with, you can find promising companies before they become Wall Street darlings. This is the fundamental idea of investing, finding good businesses and owning a piece of them for the long journey ahead. It's an adventure that is accessible to all of us. Making money in stocks sounds complicated, but the basic idea is quite simple. You want to buy a share in a great company at a fair price and hold on to it. The goal is to let the company grow over many years. As the company becomes more successful and profitable, the value of your share should increase. Eventually, you can sell that share for a higher price than you paid for it. The difference between your buying price and your selling price is your profit. It is a straightforward concept that relies more on patience than on genius-level intelligence or complex calculations. Successful investors are like detectives. They do their homework before they invest their money. They read about the company, understand what it sells, and look at its financial health. Is the company making more money this year than last year? Does it have a lot of debt? Who are its competitors? This research helps them build confidence in their decision. They are not just buying a stock symbol that zips across a screen. They are investing in a real business they believe in. This conviction is what helps them hold on when the market gets a little shaky. Another key to winning is thinking for the long term. The stock market goes up and down every day. This is normal. Trying to guess these short-term movements is a fool's game. It's called timing the market, and almost no one can do it successfully. Instead, successful investors focus on time in the market. They buy shares in solid companies and plan to hold them for 5, 10, or even 20 years. This long-term view allows them to ride out the bumps and benefit from the company's sustained growth over a full business cycle. The best time to buy is often when no one else is interested. When a good company hits a patch of bad news and its stock price falls, many people panic and sell. This is often the best opportunity for a patient investor. If you have done your homework and believe in the company's long-term future, a lower price is a gift. You get to buy more shares for the same amount of money. Buying good companies when they are temporarily out of favor is a classic strategy that has created tremendous wealth for those who have the courage to go against the crowd. Losing money in the stock market is unfortunately very common, and it often happens for the same few reasons. The biggest mistake is treating investing like gambling. People hear a hot tip from a friend or see a stock soaring on the news, and they jump in without any research. They don't know what the company does or if it's even profitable. They are simply betting that the price will keep going up. This is not investing. It is pure speculation. When the story changes or the hype dies down, the stock price often crashes, and these investors lose their money just as quickly as they put it in. Another major pitfall is impatience and fear. The market has temporary downturns, which we call corrections or bear markets. These are a normal part of the cycle. However, many people panic when they see the value of their investments go down. They sell everything at a low point, locking in their losses. They sell precisely when they should be holding on or even buying more. Fear is a powerful emotion that causes people to make poor decisions. The key is to remember that you own a piece of a business, not just a fluctuating number on a screen. The platform you use to trade can also influence your behavior. Modern trading apps on your phone make buying and selling stocks incredibly easy. They have confetti, flashing lights, and game-like features. While convenient, this design can encourage frequent trading. It makes you feel like you need to be doing something all the time. But successful investing is often boring. Constant trading racks up fees and taxes, and it often leads to buying high and selling low. A simple, no-frills brokerage account is often better because it doesn't tempt you into making impulsive moves. Finally, a lack of diversification can lead to disaster. Some new investors put all their money into one or two stocks. Maybe it's the company they work for, or a technology stock they think will be the next big thing. This is incredibly risky. If that one company runs into serious trouble, you can lose everything. Smart investors spread their money across many different companies in various industries. This is called diversification. If one of your stocks performs poorly, the others can help balance out the loss, protecting your overall portfolio from a catastrophic failure. The statistics paint a very clear picture of winners and losers. Studies have shown that the vast majority of day traders, people who buy and sell stocks within the same day, lose money. Some reports suggest that over 90% of them fail to make a profit over time. They are competing against powerful computers and seasoned professionals. It's a game that is heavily stacked against them. On the other hand, investors who follow a long-term buy-and-hold strategy have historically done very well. The S&P 500, an index of 500 large U.S. companies, has returned an average of about 10% per year over many decades. Consider the story of a legendary investor like Warren Buffett. He is one of the richest people in the world. His strategy has never been a secret. He buys wonderful companies at fair prices and holds them for a very long time. He doesn't try to predict the market's next move. He focuses on the business itself. His success is a testament to the power of patience, discipline, and doing your homework. His example shows that you don't need a complex formula to succeed. You just need the right temperament and a long-term perspective. This contrasts sharply with the stories of those who lost fortunes chasing short-term trends. The simplest advice for any aspiring investor is to start small and learn as you go. You don't need to be an expert on day one. Invest in what you know. If you are a doctor, you probably know more about healthcare companies than the average analyst. If you work in retail, you have a front row seat to the most popular brands. Use this personal knowledge to your advantage. Start by investing an amount of money you are comfortable with. And remember that this is a marathon, not a sprint. The goal is to build wealth slowly and steadily over your lifetime. In conclusion, the path to becoming a successful investor is not paved with secrets or shortcuts. It is paved with common sense. It requires you to be a business analyst, not a market timer. It demands patience when others are fearful and caution when others are greedy. Do your research, buy shares in good companies you understand, and give them time to grow. If you can avoid the common pitfalls of impatience and speculation, you will significantly increase your chances of joining the small group of winners who use the stock market as a powerful tool for achieving financial freedom.